All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. I'm putting this out about an hour early here today, just because with the way things are set, I don't expect to have any new challenge signals. Earlier today, I did jump on. I talked about the challenge and what we were going to do with the challenge going forward. So if you missed that, check it out. If I came across a little negative in a place or two, my apologies. Wasn't my intention at all. I was just emphasizing a couple points, but anyway, if I didn't, then great. But there was no negative intention there in any way, shape, or form. Now market today. We still have 2.5 hours to go, and we're looking at a market that's down 200 points on the S&P, and it has had a 160 point rally in 16 minutes and a 95 point rally in 7 minutes. The two rallies today that we have seen in the market are bigger than rallies we saw over the course of a full month period many, many months, over the last 4 years. And we've seen those rallies happen today in minutes. There is no price stability. There simply is none. We saw the rally here. This rally was catalyzed by the Fed, basically, and I put it into the message feed, basically injecting $500 billion. $500 billion into the system, a massive number. A massive number when you consider their overall balance sheet. And watch the market rally and move up and up and up. And I commented to my brother that this feels desperate. Just feels desperate by the Fed. Nice to see them acting early, but feels a little desperate. And the market continued to go up after that, and it's now pulled on back. But is Fed injection of a little bit of liquidity going to change anything of what's going on out there? It's not. We have a behavioral shift that's happening, and the Fed can inject all the money in the world and cut all the rates they want. That doesn't get to the issue at hand. And so, catalyzed a little bit of rally. The rally has faded. We saw some of the banks go green. J.P. Morgan. Here we go. Boom, boom, boom. Up went green. Went back up to 97. Now it's back down to 86. We saw bonds move on up, and they have held their gain. But that's about it. We saw the dollar pull back on the news. Gold, which has been hit hard today, rallied on the news, is pulling back somewhat. But overall, not a lot of change from earlier today. It is still a panic-stricken, free-falling, type of environment out there, and one that needs a lot more than a Fed injection to stem the panic, stem the tide here in the markets. And in fact, when you start looking at what is happening right now, we talked about the case for panic yesterday. It's some of those things that we talked about maybe down the road starting to happen now. Kind of a little bit of war of words between the U.S. and Europe. A little bit of bickering between the U.S. and China. And stemming around the causes and responses to the coronavirus. We are seeing a lot of things shutting on down. In fact, here in about 18 minutes, the governor of Utah, where I am, which hasn't been hit too hard yet with the coronavirus, is expected to announce school closures. That all schools are going to be closed. We already see some school districts closing. We see that happening across the country. And it's one of those where we can sit here and talk about the coronavirus and the merits of the virus all we want, and that maybe it's not going to affect that many people, maybe it will, and get into that whole health debate. But the reality is, from a market standpoint, from an economic standpoint, it is creating a massive change in behavior that so shows no sign of letting up. I mean, you look at the airlines, and we can argue all we want that American Airlines at $14 is an absolute long term steal, but in the short run, this thing could still go to 7. And we just have to realize that those risks are out there when we're in a free fall panic. And let's face it, there's no other word for it. Crash. The market has crashed. Or it is in the process of crashing, as we are looking at a market that is down. Let me show it to you here. I'm just going to pull up a performance chart, but has gone from up 17% to down 12%. We're talking almost a 30% move here. If crash isn't the right word for it, then I don't know what is. But this is an absolute crash scenario for the market. Yeah, it's been more of a slow motion crash rather than that fast boom, crash action that we've seen historically. But there's no other way around it. There's just no other term here for it, and that's what we're dealing with in the market right here. As far as challenge goes, challenge is in all cash. It has been, and as I mentioned in the last video, it probably will be for the next little bit. Barring some massive changes. One of the reasons it's going to be in cash is because we aren't going to see a lot of downside 3-7 crossovers and aren't going to see a lot of upside 3-7 crossovers. Now, today on the downside crossover list, we have Dollar General and Walmart, but neither are creating triggers here. Walmart, because it's moved 2 average true ranges to create the crossover, and then Dollar General is in a similar spot here of moving more than 2 average true ranges to create the crossover. So just not creating triggers, but both examples of some of the best stocks out there, or some of the stocks that you could almost make an argument that would benefit from everything going on out there. Just getting taken to the woodshed as margin calls and the fear and the panic permeates the markets here. So, we have those two crossovers, but not signals. And then on the upside, as you would expect, nothing here today. You'd almost think, hey, market down big. Maybe gold is snapping back. Maybe gold is no. Gold's down 10%, and or Barrick Gold is down 10%. Gold itself is down just around 3% here today. So not a lot being spared, from utilities to to gold to real estate. It's very difficult to find anything that is being spared here. The advancers versus decliners here, you can see the scale. The scale on this chart has been altered, and been altered in a big way with the volatility that's come in. 2,000 and 3,000 in each direction were the high water marks. We didn't get higher than 2,000 or 3,000, more than 3,000 decliners on a day, or more than 3,000 advancers on a day. But look at how the market's trading now. It's all in or all out. That's there is not much differentiation going on here with it at all, and that is a very bear market scenario. You look at the number of stocks setting new highs versus new lows. More than 2,000 stocks in the market setting new lows over new highs. That's a monster, massive number, and one that we have to go back to where? The financial crisis to see that number. We did not see numbers this bad during the tech boom, the dot-com bust. We didn't see numbers this bad during the bear market of 2002, 2001, during any of that period. 9/11, didn't see it this way. We get to the European crisis, we didn't see numbers this deep. This is, there's only one comparison. And I made those comparisons yesterday, and we continue to see that from a price action standpoint, this is comparable to the financial crisis, and we know it is because of how unknown things are out there. Can we argue the merits of the coronavirus? Sure, but the uncertainty and the behavioral changes that it has created, you could argue are far worse than the impacts of the financial crisis that we saw back in 2007, 2008, and 2009. So anyway, that's where things are. Bullish percent index, it doesn't go lower. How do you get lower? When the bullish percent index is at 1.6, how do you get lower? You don't. That's what we're looking at. It is that extreme. It is that historic. It is that unusual. The VIX, we don't ever see it up this high, except for when the financial crisis. That is all that this market compares to over the last 20 years. And, it's hard to compare it to things like 1987 just because some of these metrics didn't exist back then, and the market was very different back in those days in terms of the global nature, in terms of options, in terms of hedging, and every just we're in a totally different era these days. But we compare things over the last 20 years. There's only one semi comparison, and that is the financial crisis here. And so volatility will continue. The volatility will be pretty hefty. The option spreads and stock spreads will still be pretty insane. You go take a look at something like an Alibaba, which I watch each and every day, just curiosity and, kind of wanting to, buy it when the time is right. But you're talking, you get out of the money. You're talking about 40-cent spreads here on it. You get in the money. You're talking about dollar spreads here, 10% spreads on these with a delta that is pretty small and a vega that's pretty monstrous. It's option pricing that we have not seen in the last 12, pretty much since the financial crisis, happened back in 2008, 2009. All right. Thanks for hopping on. Have yourselves a fantastic evening, and we'll talk to you tomorrow. Take care.